Hey guys, Dave Keller here with Market Misbehavior. The S&P 500 certainly has been under pressure so far in 2021. We're a couple weeks in. We have the Fed meeting this week. We're right in the meat of earnings season, and the market overall has felt a lot of weight with growth areas of the market pushing the S&P lower and lower. I thought it'd be a great time to do a choose your own adventure style video. I'll give you 4 scenarios, potential outcomes for the S&P over the next 4 to 6 weeks. Which do you see as most likely and why? So today it's all about the S&P 500. So this is an exercise I always enjoyed doing with some of my peers in the industry. You take a particular asset class, particular stock or ETF. In this case, we use the S&P 500, and we draw out some potential outcomes. Here are some 4 potential future paths for the S&P 500, and then the discussion is which of those do you see as most likely and why. So part of this exercise is to help think about which scenario you see as most likely and think about what your positioning might be relative to those expectations. But really the main goal of this exercise is to think about these different scenarios. Think about some of the scenarios you think is rather unlikely because they're still possible. All 4 of these are possible. Any one of them may happen. Some of them certainly more likely than others, but think about how your portfolio, how the markets in general, how individual stocks or sectors or themes may play out given some of those different scenarios. And that is how you think about risk management and risk and reward like an institutional investor. So I'd love for you to take a look at these 4 scenarios before we get to the charts. If you like the sort of thinking about market history, investor decision making, and psychology, all of that sort of thing and more, subscribe to my channel, won't you? It'd be great to have you along the ride. Also, give the video a like if you appreciate it. We'd very much appreciate that back. Make sure you comment below which of these 4 scenarios do you see as most likely and why. Let's get to the chart. All right, so here we're looking at my daily chart of the S&P 500. We're going back to September, October of 2020. So it's about a year and a half of history. I'm recording this here in mid to late January. And I wanted to bring in enough history just to go back to the last major low in the S&P, right? You had the March 2020 low, you had the June 2020 low, and then September and October, November was sort of the most drawn out congestion period, right? After that March 2020 low, this is a 3-month consolidation phase, a coil pattern or symmetrical triangle pattern that resolved to the upside, and then it's pretty much been off to the races. Deepest drawdown in 2021 was in September, is about 6% from intraday high to intraday low. We've already doubled that so far in the first couple weeks of this year. So we opened up 2021 touching 4,800 on the S&P. Overall, we've gone down about 12% on an intraday basis. We haven't closed that far down, and so on a closing basis, it's more like 10% here, back up just below the 200-day moving average. Now, a lot of these lines on the chart are my own lines, and I'll just explain what each of those are. Then I'll talk through the 4 scenarios. So the blue line up here, this blue shaded area, is the all-time high, just right around $4,800 a share, which we first reached in January. The brown shaded area here is the high from November and December. This was a significant area of resistance. We broke above it, came right back below it and retested it. And that was the failure when we really accelerated to where we're at right now. This pink shaded area is an important level right around 45.50. That's the high from September of last year. That was a key level because we broke above there and then came back and tested the lows there in December, retested them again in mid-December, and then we finally broke down there. That illustrates the concept of polarity, both of those levels. And if you don't know what that means, I have a link in the description below to my previous video on the concept of polarity and why 4,700 and 45.50 are such important levels still, I would argue, for the S&P 500. Finally, we have this orange shaded area right around 4,300. These are the lows from September and October of last year. This was the deepest drawdown of the year last year before we resumed the uptrend and powered into new all-time highs in January. But we've once again traded down to that level. We've traded to or just below that level a couple times so far this week, but have not closed below. And I think 4,300 remains a really important level. I also have some Fibonacci levels on here at 4,200, 4,000, just above 3,800. And these are based on the September low to the January intraday high from this year. And then the last one's the 200-day moving average, which is sort of here. We're trading below the 200-day. We actually just traded above it today, but closed back below it. That sort of gives you a sense of all these different levels on here. I also have the RSI at the bottom, good measure of momentum, just to show that we are oversold for the first time, actually going back to early 2020. So what are the 4 scenarios? So the way that I would think about this exercise is think about the very bullish scenario, the very bearish scenario, and then the two in the middle. And we'll start from the most bullish to the most bearish and go in order. So question number one, I think for a lot of investors, is the bottom in, right? We sold off Monday of this week, traded almost down to 4,200, which took us almost right to that first Fibonacci support level. Overall, it's a 12% decline from intraday high to intraday low. Pretty significant swing, and we gave up 6 months worth of S&P returns in just a couple of weeks. And so the question is the low in? If that would happen, then a lot of names that have pulled back to support would have to hold that support. A lot of the FANG stocks that have gotten super beaten down would have to not get any more beaten down than they are already. I'm looking at you, Netflix and Amazon and others. And you'd also have to see renewed strength in some of the cyclical sectors like energy and financials to push to new highs, which would be able to drag the S&P 500 itself over. Because it's such a growth-oriented index, you'd most likely need to see the growth stocks start to work pretty well. So the very bullish scenario, I would argue, is the low is in. We don't get below that intraday low for quite some time, and we have a V-shaped recovery, similar to what we saw sort of in March 2020. And again, maybe a little less of a drawdown, but overall a similar shape. We have this, the sharp sell-off, a sharp recovery, and we return up to at least the previous highs, right? We get to at least 4,800 and we make new highs in the next 6 weeks. So that would be the very bullish scenario. That would mean all the distribution that we've seen so far is over. Breadth conditions don't deteriorate at all from here, and we rotate right back to the upside. Scenario number two, sort of the mildly bullish scenario, is the low is in, all right, same as the first scenario. We don't get below 4,200 in either of these first two scenarios, but we don't get near those previous highs. I would say the mildly bullish scenario means we really stay in this range from 4,200 to 4,550 or so, sort of between the low that we established this week and sort of that breakout level from before. Maybe we get a little bit higher, but not with any significance. We really don't retake or get close to that 4,800 level. So the very bullish scenario is we blow through and get right back to the previous highs or higher. The mildly bullish scenario is we don't get any lower, we really don't get back to those previous highs. They're sort of range bound. It's more of a choppy phase. And this ends up being less of a price correction and more of a time correction. So scenario one, the correction's over, the pullback is over. Scenario two, the pullback is not necessarily over, but not any more price pain. It's more of a time, more of a consolidation phase for a little while. And we remain above 4,200. The third scenario is sort of the mildly bearish scenario. That's where we do break 4,200, but we don't get below 4,000, right? So that would take us a little bit further. That would end up being about a 20% haircut from 4,800 down to 4,000, which would be sort of the textbook definition of a bear market, right? If you have a more than a 20% sell-off, you're then, I guess by anecdotal labeling, you're in a bear market phase. So the pullback draws down, the drawdown continues. We see further price deterioration, but not enough to trigger that horrible bear market label. We don't go any further than 20% below the all-time high there, which means we remain above 4,000, sort of settle into this range. We sell off to 4,000, but then don't get any lower. We have a little bit more pain, but the pain will be over soon. That's the third scenario. The fourth scenario, scenario four, is the very bearish scenario. That's where 4,200 does not hold and 4,000 does not hold. I think the bear market scenario goes to 3,800 or less, right? So we get at least down to that last Fibonacci support level, and anything more painful than that fits into that fourth bucket of a lot of pain. And what that would mean is basically the growth trade is so broken that a lot of those stocks like semiconductors and others that have pulled down to key support are unable to hold it. In that scenario, probably the energy and the financial stocks that are starting to do pretty well all start get dragged down, and the negative movement in growth is just too much for those names to hold on. And instead of it being value over growth and more of a rotational period, this ends up being more of a broader move to defensives, where people sell out of anything but some things that are really more defensively oriented, might be into fixed income instruments or gold, or really defensive sectors like utilities and consumer staples. Those are the only sectors that perform anywhere near acceptable, and everything else is pretty much taken out to the woodshed. So those are the four scenarios that I'm describing. The very bullish scenario means the bottom is in. It's a V-shaped recovery. We get above the 200-day, above 45.50, and we're at or near all-time highs yet again, or higher in the next 6 weeks. The mildly bullish scenario number two, the mildly bullish scenario, is the bottom is in. We don't get below 4,200, we don't really get much above 45.50. You sort of spend time in this range and back and fill it in there. So the low is in, but we really don't have a recovery. It's more of a sideways trend. And that could be a scenario where growth keeps not working, value sectors sort of work, and the S&P nets out to sort of a flat, choppy environment. The third scenario, the mildly bearish scenario, means we break down through 4,200. We don't get below 4,000, which would keep it outside of the textbook's definition of a bear market. We wouldn't lose any more than 20% off of all-time highs, but we feel a little bit more pain, and it's a little more drawn-out experience. The very bearish scenario means we do not hold 4,200 or 4,000. 6 weeks from now, we're actually below 4,000, and that would be a scenario much more in line with February to March of 2020. So that's it. Those are the 4 scenarios. And again, the real important part of this exercise is to think not just about which scenario you think is most likely, but to think about all 4 of those. What would your portfolio, your current portfolio, look like in the very bearish scenario, the very bullish, mildly bullish, mildly bearish, and very bearish scenarios? What would happen? What signals would you see from the chart of the S&P that would convince you that that trend is in place and that you may need to make changes to your positioning? If you like this sort of thinking about investor decision-making, behavior, market history, and technical analysis, I hope you'll subscribe to my channel. It'd be great to have you along this ride. Also, if you like this video, give it a thumbs up. We'd very much appreciate it. Finally, put a comment below the video. Let me know which of those 4 scenarios you see as most likely and why. From everyone at Market Misbehavior, I'm Dave Keller. Be safe. We'll talk to you again soon.